you. I'm going to call this meeting of the Council Budget and Finance Committee to order and let the record reflect that all three members of the committee, I believe, are here. Council member,
yes.
Yeah, Wahab, yes, I see. Okay, and Council member Lamnon and I. So let the record reflect that all members are present. We will now move to public comments. I see we don't have anybody in the attendee list. Do you know of, is there anybody?
I do have one, Mayor.
Okay, go ahead, Mr. Clausen.
Sent by email. 1 second, let me pull it up. It is from Mr. Cordell Hindler. He would like to invite the Finance Committee to a performance of Anton and Show Business at 7:30 p.m. at the Contra Costa Civic Theater. It's $30 per adult and proof of vaccine is required. And that is at 951 Pomona Avenue.
Thank you. Well, I'm sure that will be done with this meeting in time for anyone who wants to take advantage of that. So, okay. So moving on now to, if there's no one else who wishes to make a public comment, I'm not seeing any hands raised. I do see one attendee now, but okay. So we're going to now move on to our next item, which is approval of the minutes of our February 16th meeting. Any?
I'll second.
All right, moved by Councilmember Lamnon, seconded by Councilmember Wahab. Is there any of, I support the motion. Do either of you not support the motion? Or conversely, do both of you support the motion? Okay, with that, the minutes are approved with a 3-0 vote. We will now move on to just this item that is just so easy to get your head around, but I'm sure Mr. Clausen will help us do that. This is item number 2, CalPERS pension unfunded accrued liability update and an introduction to restructuring concepts. Mr. Clausen, I'll turn it over to you to start us off.
I will certainly do my best, but I've also got I brought some backup with us to help to explain what is a very sort of difficult to understand and at times a very abstract concept. And so tonight we've got with us Craig Hill and Mike Myers from NHA Advisors. They're the city's financial advisor. They've helped us with many things over the course of some years, including helping with all the financing that the city has undertaken. They've got quite a history of helping agencies to better understand their CalPERS liabilities and unfunded liabilities, as well as looking at different tools to help agencies restructure those liabilities here in the state of California. So they've got a presentation prepared that they will give to you guys, and we'll obviously answer as many questions as we can here this evening. And then also ask that you provide us with your feedback. And if so moved, you all would like us to bring this to the full council, we'd be more than happy to do that, or have further conversation here, do additional education, etc. So without further ado, I will turn it over to Mike and Craig.
Thanks, Dustin, and good evening, Mayor and committee members. Mike Meyer with NHA Advisors. Just want to make sure that the screen is sharing and that you could see it. Yeah.
Yes.
Perfect. I'm going to jump right into it. This presentation is focused on a little bit of an update on the debt that the city has with CalPERS. That's known as the unfunded accrued liability. That number, based on the latest actuarial reports that were released this past fall, is about $493 million. As you're probably well aware, that number has grown rapidly over the last decade or so, just due to CalPERS assumption changes and investment underperformance. So just over the last 8 years, it's grown 75% from 280 million up to that 493 mark. It's been a large impact on the city's budget. Those payments to amortize that debt have doubled just in the last 5 years. So Those payments were about 17 million in 2017. This fiscal year, they're a little bit over 34 million. CalPERS does charge a 6.8% interest rate on that debt. There is some good news, and we'll get into what the impacts of this good news are on the next slide, but CalPERS did have a very good year last year, so that should be reducing this UAL number, although given the stock market volatility lately, they may be underperforming this year, so we'll talk a little bit about what that may mean as well. And then as Dustin mentioned, one of the most of the presentation is going to be focused on a concept called restructuring the UAL using a pension bond. It's a fairly complex topic, so we're going to introduce it, talk a bit about some of the nuances, the risks, and also what that process would look like if it's an idea that the city wanted to explore further. Slide 3 here is a snapshot of what the city has been paying on that UAL going back to 17. You could see those blue bars there at around the $17 million level. They've creeped up to that $34 million mark. And then the blue bars also represent what the projected payments are on that $493 million unfunded liability. As I mentioned, CalPERS had a great year last year, the 21.3% returns. We expect that to reduce the UAL to $414 million. And the impact of that you can see in the dark blue line there. So really the benefit is would be that the payments would be stabilized around that $40 million mark each year for the next decade or so, as opposed to creeping up to that $50 million mark. Should mention that CalPERS has been on track to underperform this year, to not meet their 6.8%, just given that the stock market has been volatile and is down. So just to give you an idea of where that UAL would rise back up to, 477 million if CalPERS were at 0% this year, and that UAL would go over 500 million if CalPERS were at -5%. And then lastly, as you can see on that bottom bullet on the left, and one thing that's not reflected in this chart is that the city also makes normal cost payments to CalPERS each year. This is the cost to keep up with current employees, and those costs will be jumping up by a couple $1 million starting in 24 because of the recent discount rate reduction from 7 to 6.8%. On slide 4, we summarize the more common cost management strategies that are being utilized by other agencies. City of Hayward already utilizes 3 of these, numbers 1, 2, and 4. But just to briefly go through those, number 1 is to prepay that UAL every July. So instead of making monthly payments, just to prepay it early in the fiscal year, you do get a discount by doing that. Number 2 is negotiating with employees to make sure that everyone's paying their fair share. And then the 4th one that the city has utilized is to pay more into the pension system than is required. So using reserves to pay extra. There's really 2 primary ways to do this. The first of which is to set up a separate trust, which the city's done. That's known as a Section 115 trust. And second option is to just send that money directly to CalPERS. The third option there in teal that I skipped over is to request a new repayment shape from CalPERS. This is not a very popular option for a couple of reasons. The first of which is that CalPERS does require you to shorten the amortization period, meaning that your annual payments are higher. Most agencies don't want higher payments and can't afford that. The second reason most agencies haven't moved forward with the fresh start is that you're locked in. You can't go back to your old repayment schedule. So if you are wanting to pay extra, typically agencies use the 4th strategy, which still provides you some flexibility there, but still effectuates the same thing of paying more, paying that debt down faster. The last option is to restructure that UAL at a lower interest rate using a pension bond. And that is what the remaining slides are focused on. So what is a restructuring? It is where a agency issues a bond and takes those proceeds and pays off a portion or all of the unfunded liability with CalPERS. The primary structure that most agencies use is a pension obligation bond. Some agencies have used a lease revenue bond, but the vast majority have used a pension obligation bond. This is an unsecured debt, so there's no collateral that's required like a lease bond in terms of assets. The one unique thing about a pension obligation bond is that you do need to go through a court validation process to legally confirm that that UAL is a debt imposed by law that can be refinanced. That's about a 4-month process, and we'll talk a little bit about that process on a future slide. The two main benefits or two primary reasons why a lot of agencies have executed a restructuring in the last 2 years is, number one, rates have been very low. So there's been about 90 agencies that have issued these bonds in the last 2 years. Interest rates have ranged from about 2.5% to 4.25%. The second reason, and probably the most important reason in our opinion, is the ability to put into place a new repayment shape that's a bit more predictable and smoother, which helps with future resiliency and sustainability. There is risk with a pension bond in any UAL restructuring, and we have a couple slides that are solely focused on the risk aspect of this type of transaction. Just a few slides on the market. As I mentioned, there's been, I think at this point, about 90 agencies, all CalPERS members that have issued UAL restructuring bonds. It's refinanced about $8 billion of unfunded liability. About 75% of those were issued as POBs, the remainder as lease revenue bonds. Interest rates have been very volatile. When the first wave of these came to market in 2020, those interest rates were anywhere between 3.5% and 4.25%. Last year, we saw rates, the majority of deals were under 3%, so 250 to 3%, up to 350. This year, we have seen an uptick in interest rates. There's only been 2 transactions issued this past January. Those rates were above 3%. At the time we put together this presentation, we estimated that rates were probably between 3.5% and 4%. As we'll talk about in a future slide, they may be closer to that 4% or even higher mark, just given what's going on with the Ukraine crisis right now and inflationary fears. Slide 7, as I mentioned, one of the benefits of a restructuring is to tailor the repayment shape in a way that works best for each individual agency. So this slide is really just to demonstrate that there hasn't been a one-size-fits-all approach to any of these pension bonds. If you look at all of these transactions, each of these agencies has taken out a different amount of the UAL, whether it's a fraction or up to 100%, and they've all put into place a different repayment shape. So some cities are listed here on 7. You can see that they all took a little bit of a different approach to their repayment shape. Ukiah had a escalating structure and then declining in the back end. Riverside, they just smoothed out that peak in payments. If you look at the top right in purple, and then had declining payments in the back end. And then if you look below, you can see El Monte stretched out their debt to about 30 years just to bring down that annual payment as far as possible. That's in the orange line. And then Corte Madera, they kept the same term. They just leveled out their payments for the next 24 years. That's shown in the bottom green line. As I mentioned, interest rates over the last few years have been at historic lows. You can see just looking at the last 30 years or so in the blue line, we're at relatively low levels from a historical perspective. But if you look at the top part of this slide, this is just the last 12 months. And if you look at the right half of that box, you can see there's been a pretty rapid increase in interest rates. at the time of doing this presentation, it was probably 50 to 70 basis points over the last couple of months. That's 0.5%. At this point, it's probably even a little bit higher. Slide 9, just again, as I mentioned, rates have been fairly volatile for these types of pension bonds. This chart shows the trend of interest rates over the last 2 years. So it's in chronological order. So on the way left, those are issuers who came to market in the spring of 2020 when rates were at around that 4% mark. You can see that those rates in the blue bars started to drop very quickly. So most of the cities who came in 2021 were in that mid to high 2% interest rate range. And then late last year, we started to see rates creep up. The most recent transaction was a 3.35. At the time of this presentation, we put a star there on the top right. We felt that rates were around 3.50 to 4%. I'd probably say today they're at around 4, if not a little bit higher. So we've seen probably a full percentage point move just in the last couple of months. And obviously we don't know if they will go higher or lower, but it has been trending in the upward direction. We did run some preliminary analysis for the city of Hayward. We didn't want to overwhelm the committee with too many options on sizes and shapes. So we just looked at refinancing the new projected lower amount, the $414 million, with level payments through 2044. That's the same term that CalPERS currently has the city on. So these blue bars represent your current projected payments with CalPERS. They're anywhere between 37 and 40 million per year. And then that blue line represents what a hypothetical restructuring would look like. Again, when we looked at this, we were estimating a rate of about 3.65. And that annual payment level right there is around 27 or $28 million. In terms of the numbers behind that chart, and I might actually flip to slide 12, because just today we updated the analysis with interest rates that are about 50 basis points higher. So as you can see there in the middle of that table, that all-in interest rate right there is about a 4.16, which we think that could be conservative. It could be accurate. The market is probably the most challenging market we've seen in years, so it's hard to know exactly where these would fall today. But wanted to give you an idea of what the savings, the projected savings would look like at over a 4% interest rate. So on a present value basis, those savings are about $75 million. On an annual basis, they're a little bit under $10 million. So that bottom row there, 9.77 million. And just to compare that to the analysis with the lower interest rate, when we did this presentation 2 weeks ago, based on the 3.6% interest rate, that annual savings number was about 11.2 million. So you can kind of see the impact there. If rates were to go up, that's the amount that savings would come down on an annual basis. As I mentioned, these types of refinancings, there really are an infinite number of options. A lot of cities take out just a fraction of the UAL, so maybe 50%, 30, 40, 50%. There's a lot of targeted ways you can, it could be the safety plan, it could be the miscellaneous plan. You can really tailor it to meet your objectives. There's a lot of agencies that go the full 100%. I would say the vast majority have done around 2/3 of the UAL just to bring their funding ratios up to the 90 percentile, but not getting too close to that 100%, just because there's some risk with going overfunded as well above that 100% ratio. The other important word we want to bring up is resiliency. Whether you do a pension bond or not, the city will continue to be hit with new UAL anytime in the future whenever CalPERS underperforms. And so if you were to pursue a restructuring, making sure that that new repayment shape gave the city enough capacity in the budget to absorb future shocks would be recommended. That resiliency is very important in our opinion. Lastly here, don't want to jump ahead too quickly, but stress testing the options to quantify risk is very important. And we'll get into that a little bit more on the next couple of slides. I think the benefits are fairly clear in terms of the savings and the enhancement to budget predictability by smoothing out those payments. So I want to dwell on the right side of this chart here, which is the risk of a UAL restructuring. And the core risk is that these savings are not guaranteed. They are dependent on future CalPERS returns. So the savings that we're projecting of, let's call it 10 million per year, that does assume that CalPERS earns their target rate of 6.8%. If they were to be below that, actual savings from the refinancing would be lower than we're projecting. If they were to be above that, the savings would be higher. The rule of thumb is that the city's better off on a present value basis as long as CalPERS earns above the interest rate on your bond. So if let's say Hayward were to borrow at 4%, as long as CalPERS earned above 4% over the next 20, 25 years, you would be better off on a present value basis. If they earned less than 4%, so if they earned 2 or 3% over the next 20 years, you would have been slightly worse off on a present value basis.
I'm just sorry to interrupt here, Mike. And I don't think it's probably news to the committee, but wanted to make it very clear. If CalPERS is earning at 4%, we're having a completely different conversation, and there are much bigger issues going on. And let's all hope that doesn't happen. Clearly, they have not performed that way historically. But if that's the case, we've got much bigger issues, and we and all other agencies in the state have much bigger issues. So sorry.
No, I appreciate that. At the risk of overcomplicating things at this first meeting with some quant, we did think it's important to introduce this concept of stress testing because there is risk, the risk of CalPERS underperforming, but there's a lot of ways of quantifying that risk. So if this ever were a strategy that the city continued to pursue, we would highly recommend some pretty comprehensive stress testing where you could kind of come up with scenarios and look at how, what the impact to the city would be with and without a restructuring. So things like, what if CalPERS only earns 4%? What if they only earn 5%? What if there's another 08 recession that starts, in 2 years? Those are all things that could be modeled out. We took a crack at kind of doing some preliminary analysis here. And so what this chart on the right side is showing is, we talked about a present value savings number of around 75 million on the prior slide. And I mentioned that assumes CalPERS earns 6.8. What this chart is showing is how that savings changes if CalPERS earns higher or lower than that 6.8. So obviously, if you look on the right side of that chart, if they earn 7, 8, or 9%, those savings go significantly higher. 109 million if CalPERS earn 7%, 160 million if they earn 8, and over 200 million of savings at 9%. Conversely, if they earn lower than 6.8, those savings go down. So if CalPERS only earns 6%, if you look up at that middle blue bar, that's about 67 million of savings. So it goes down. If they only earn 5%, those savings are 33 million. And it keeps going down. And if you look at that 3% assumption, the city would actually be slightly negative on savings if CalPERS were to earn 3%, let's say over the next 22 years. Again, this is on a present value basis. What we would, if this were something that the city pursued, we often will recommend actually looking at the cash flow impact of a lot of this as well. Because under even a lot of these more pessimistic situations, you're still better off from a cash flow perspective for at least 10 or 15 years, where you start to see the impact is out in 15 or 20 years. So that's a second part of the stress testing that we'd always recommend, whether it's the advisor or an actuary doing that type of analysis. The other stress test we did is more of a market crash scenario, because you are, when one does a UAL restructuring, you are giving CalPERS a big chunk of money at one point in time to go invest into the market. And so some of those gains and losses in the first few years get magnified based on how they do. And so what that chart on the left side does is we assume that CalPERS loses a lot of money in that very first year after doing the pension bond and doesn't recover. And so you can see the impact to savings there. If CalPERS were to lose negative 10% in the very first year after the pension bond, those savings are cut in half down to 36 million. And you can see that, if you get out to a scenario where CalPERS loses 20% the first year, so that means they missed their mark by 26.8%, that's about break even. So you'd be, barely negative on the savings. This slide we also want to bring up to the committee and note that the GFOA, the national organization, has not recommended pension obligation bonds. They have 6 reasons for that. 5 of those reasons are not applicable to California CalPERS UAL restructurings, and I'm happy to go through those if you'd like, but those are not applicable. A lot of these were based on pension bonds that were issued in the 2000s, which were there was a lot of swaps involved, variable rate. Those bonds were not issued with the flexibility to call the bonds or to pay them off early. All the bonds now that are issued do have a call feature, so you do have the flexibility to pay them off early. But the number one reason is the same risk that we just introduced on the previous slide, and that is that there is a risk that CalPERS does not earn above that rate on the bond, and that your savings would actually be slightly negative. So again, that's why we encourage stress testing. Obviously, as interest rates go up, the results of that stress testing look a bit different. If interest rates are at 5 or 6%, you're kind of counting on CalPERS meeting that mark. So those that risk reward calculation is a bit different. So again, something that we always encourage. The other part of whether the city executes a restructuring or looks at a restructuring or never pursues one, the importance of a pension funding policy. These are looked at very favorably by the credit rating agencies in terms of having a plan on how to address these long-term, these rising pension costs. So this is a hypothetical look at an example of a pension funding policy from one of our other clients who did do a restructuring. And really it's providing a roadmap on how the savings from that pension bond will be leveraged. And so that's obviously very different for each agency, depending on your needs, whether some of that money should go towards capital, whether it should go towards reserves, a 115 trust. We have clients that have also set up reserves that will be used to pay down those pension bonds early. So we call it a bond call reserve. From a risk mitigation standpoint, the one thing you can do is build up funds in a 115 or another reserve, because if there was a downturn, what you'd want is a shock absorber there to dip into and kind of keep that budget predictability with the restructuring, and use that fund that you've built up with hopefully some of those savings or other funds to utilize during those tougher years. wrapping this up, 2 more slides here. As I mentioned, the one unique nuance of this type of structure for a pension obligation bond is that a court validation process is needed to confirm that this debt is legal, that the UAL is a debt imposed by law. That is about a 4-month process, 3 to 4 months, depending on the county. During COVID, we've had some take 6 to 8 months, so it's really hard to predict. That process does not lock an agency into doing a pension bond, but you do need to go through that process to preserve that option. Once you get through that process successfully, you don't have to do a pension bond. You could do one 10 years from now. That validation works forever. For some agencies that, as you've probably heard tonight, this is a fairly complex subject. There's a lot of analysis, a lot of stakeholder education, a lot of guidance we would want from council and staff on options to bring back if this is something you're interested in. So that is a lengthy evaluation process as well, probably 3 to 5 months. So some agencies have kind of dual tracked this, where they start the validation, they continue with the evaluation. Others have, done the full evaluation first and then decided to start the validation process. But I think given the rising interest rate environment, it's at least something we want to bring to your attention, the idea of kind of dual tracking those things for efficiency. Dustin, do you want to handle kind of wrapping it up? I think that's most of the information we wanted to deliver, but I'm sure there's a lot of questions and happy to get into Q&A.
Yeah, sure. I think, Mike did a great job kind of describing things at as high and simple level as can be with something as complex as this. Certainly it's something that we wanted to bring to the committee for their, just thoughts and consideration. Where it goes from here is really up to the committee and then eventually council, should you guys recommend we bring it that direction. I guess what I would say is it would be my recommendation, if nothing more, than to go through the legal validation process that Mike described, that can take a few months, because as he described, we've seen, the volatility that it's subject to increases or decreases in the, interest rate market and CalPERS performance. If we were to see some, let's say we went down the path and decided, interest rates are too high, CalPERS is underperforming, we don't even want to consider it today. But 5-10 years from now, it's a possibility. The city's position to be able to pull the trigger a little bit quicker and execute so that we can, put the city in the best position and offer it as a tool. Whether that tool is ever utilized or not, is entirely up to the council and sort of the market conditions. So, obviously there are many steps between here and there. But wanted to bring this to the committee to have a conversation and for its consideration. And obviously we're always trying to find ways to help the city reduce, including the conversations with this committee, help the city reduce its unfunded liabilities, and certainly find ways that we can relieve stress on the city's budget. So with that, happy to answer any questions.
Okay. And I'll go to the others, but let me just start off with which I thought was, based on reading the report, would be a recommendation that we at least go through that process. What is the cost of doing that? Is there a cost of doing that? Obviously it's going to involve staff time or something,
I could take a crack at this from a pure, really it's legal fees. So your bond counsel who does the legal work on your bond transactions would submit the validation paperwork. There are legal documents that go with that. We've seen fees anywhere between 10 and 20,000 for that process. So that's something that's really not, non-contingent type of thing.
Okay, thank you.
Mhm.
All right, so I think we all have your slides because they were part of the packet. So can we go back to not sharing the screen? Yeah, so I can see everybody. Okay, thank you. Maybe there was a way I could see everybody anyway, but I wasn't doing that. Okay, so Councilmember Lamnon.
Thank you. I am so excited about this item. I can't even tell you. So, actually, going back to the mayor's question, is the bond council's amount, whatever it might cost to get this work done, the evaluation part done, is that already in
Sorry,
the budget?
Councilmember Lamnon, I don't know if it's me, but you're very quiet.
I will try to be louder.
That's better.
I can hear you fine. Yeah.
Okay, great. I'll use my projection voice. So is the money to do the evaluation process, is that already in the budget?
I mean, we can
Reasonably speaking, I mean.
Yeah, reasonably speaking. I mean, if we're talking about $20,000 to $30,000, we can probably find ways to scrape that together. Even if it is something that we have to come back to council for at mid-year, those types of things, it's not going to have a great impact on the $30,000 that we have to spend for to go through the process, the analysis, and then take it to prove legally that it is a debt of the city. Is minimal and wouldn't have a huge impact on the general fund. Certainly, it could be shared amongst other funds. The liability is not just a general fund liability, as we all know, and so we do have. It seems weird. We do have partners in other funds that can fund a portion of those costs as well.
That's a good point, right? It cuts across our enterprise funds, and yeah, I sort of wanted to check in if we decided to go ahead and authorize that, would we have to wait until the next fiscal year, or could we find it in this year's budget? It seems like we could. Okay, so one point I'm not 100% sure I understand. So I know the discount rate is the amount that CalPERS is trying to get from investments. Can you speak briefly to how that's also the interest rate we're paying?
Same question.
Yeah, so I'll take that. So the discount rate is what they believe they can earn in the marketplace. So that's what they're going to charge their members because they believe they could take that money and earn it the same amount. That number has been reduced though, as you may have heard, like 6.
Yeah, no, I want to go back, sorry, to the part you were starting to make, and I just want to make sure I understand that. So, okay, I'm going to leave aside the expected return part of the 6.8, the discount rate, and I just want to focus for a second on how the city is charged that amount. That's what I'm not 100% understanding.
So when CalPERS comes up with its rates, it factors in those earnings, and they change, as you well know, they change what the city owes each year, right? Each time they have an actuarial. So they factor in what that cost is going to be, what their earnings are expected to be into the rate that they charge the city. And certainly when it fluctuates, if it goes, if they're expecting interest rates or to be able to earn more, they're going to charge us less. If they expect to not be able to earn more, they're going to charge us more. I mean, that's my old mafia joke. They tell us what to pay and we pay it. So, that's how it factors in. And, I agree with you, Mayor, but that again.
Do you understand what he just said, Councilmember Lamnon?
Yeah.
Because if they expect to earn 6.8%, why are they then also charging us 6.8%?
So it's not a 1-for-1 necessarily.
Okay, it's not. Okay.
But as we all have experienced, what they state that they expect to earn is not always based in reality. And so when they know that they're not likely to earn what, when they project, and we know that they look at things on more than an annualized basis when they're setting their discount rate, correct? And so when they do that, they're looking at a longer period of time. When they set their annual rates, they're adjusting it for, you know, a shorter period of time. And it's much more, you know, it is much more volatile than a, you know, expectation that you'll earn 6.8 over, you know, 20 years. It's looking at the single year window.
Okay.
Is it safe?
More questions, Kelly?
So to me, I definitely want to move ahead with the evaluation. I obviously want to hear from my colleagues, but I'll go ahead and put my opinion in, and I'll modify it if I get swayed in a different direction. But I'm inclined to have us go through the evaluation process and the education process as dual track, as much as staff capacity allow that, because of the volatile nature of, you know, if we're refinancing at 5.5%, I don't know that it's really worth it. But anyway, and at the very least, why I'm inclined to support it is that it feels like, and maybe I'm not understanding this, but it feels like it really smooths out our volatility. Even if what we end up at the end is paying that same savings back to CalPERS because the market hasn't done what CalPERS needs it to do, we've at least sort of controlled our costs in a way that feels more manageable and less volatile to the whims of CalPERS. And obviously we'll have to have some strong policy around what happens with that savings, because it's still one-time money, blah, blah, blah. But that's a fun conversation to have later if we really go down this route. And also where our 115 trust might pay into. Even things like, if CalPERS starts charging us even more money, do we maybe actually want to put it in the 115 trust? Maybe that actually gives us a better return, but that's sort of a different conversation. But anyway, I would like to see us continue to explore this idea. Thank you.
All right. Thank you. Councilmember Wahab?
I kind of wanted to ask, have you guys been in touch with labor to see, you know, if they have an opinion on this as well?
We have not at all. I mean, we're so in the infancy stages of the conversation, and certainly if we were to start heading down this path, we certainly would. But in my mind, this wouldn't change much in the way of what would be expected as far as what's been negotiated, and nor would it change what CalPERS employee share of the normal cost would be.
Okay, true. However, I think that, you know, they would potentially want to be, you know, notified that something's happening, that the city's doing something, right? So I do just want their input, even if it doesn't change anything there, because each of them are structured differently. Some people are closer to retirement or paying more attention than some people who are, you know, like myself, not necessarily retiring in the next 5 years. So I think that that's important, at least for me, to get kind of their input or feedback. And obviously we have several different groups, from police to fire to, you know, SEIU and all the rest. And then at the same time, can you put up that last slide in conclusion? I apologize.
Is
This one?
Yes. So I'm, you know, I understand, I appreciate the, you know, the concept of restructuring. I think right now, you know, on a personal level, people want to restructure what they're dealing with, and even at this level of city. So I'm not opposed to it. I just would like a little bit more input from those that would potentially be, you know, affected, if not, you know, not necessarily their contract, but still it is something that they're dealing with a little bit more.
Councilmember Wahab, I'll just, you know, absolutely, labor will be on our list of stakeholders to outreach to. yeah, I think it's just, to be clear, this should have the zero impact on anyone's personal retirement.
Yeah, no, I
And
understand
if
that.
if anything, it should make the city more financially sound to be able to ensure coverage of payments and things, retire medical, other benefits. So, but absolutely, labor will be on our stakeholder outreach list.
Yeah, no, I'm completely fine with it. It's just, I do want their, input and for them to be notified. I just think for the mere fact of transparency is important. I don't really have any opinions on this. I think that it's good that, if the less volatile, the more, stable we can have this, the better. That 8 years, it's almost doubled, is quite disturbing in so many different ways. So that's something that, we all should take a look at. But other than that, I did not have any other comments, except for I would like a little bit more information if possible.
Well,
Can I-
so are you agreeing with Councilmember Lamnon that we initiate it by going through that, what is?
I think a study is perfectly fine. I think, starting it is perfectly fine, but as we started, I would like the input of other folks, or at least the notification that, hey, this is something that the city's looking at. This is where we're kind of headed. And that's it. So I'm perfectly fine with that.
Okay.
Can I add something really quick?
Yes, go ahead.
Thank you. Certainly a fair point to that labor is part of this discussion. Absolutely, Councilmember Wahab. And to that end, all of my conversations with labor include the unfunded issue. And so because I've been talking with them, I did actually send them this report, just FYI.
Did you hear anything back from any of them?
I heard from a contact at SEIU, just some curiosity about kind of what that was thinking about, or, what, yeah. So.
Yeah, no. So for me, I obviously we all have like a, responsibility to be as transparent as possible, but I'd kind of like to formally understand what their potential position may be. That's what I'm asking for. Thank you.
Yeah, I don't know that. I mean, since this doesn't in any way change, what we would have to be paying them, or, what their retirement benefits are, I would think that, we're all looking at doing this because we can see savings in the future, and extra money to spend. And that should make labor very happy if we have.
I mean, it clearly would not be. Yeah, Mayor, it clearly would not be a negotiable item. It's
yeah, right.
management right to do this, but in the spirit of our good labor relationships, we would obviously keep them informed of what was going on.
Okay. That to the it's always sort of like gambling, which I hate. I hate gambling, but you have to. I think just today the Fed did raise the whatever that rate is that they have, a 0.25 percentage point. The rate going up, the rates going up, which they appear to be doing right now. I mean, in some ways, if they're going up during this time we're looking at it, which they wouldn't probably change that much, we are at a historically low, although it's been climbing a little bit, right, rate. And the more it climbs, the less benefit we would end up getting, right? But on the other hand, the more the rate climbs, the more return we can expect from the CalPERS earnings as well. I think you said that, and that makes sense, right?
That's possible.
It's possible. It's not guaranteed, but they might. Okay.
And Mayor, I mean, I've said it a few times. My position on pension obligation bonds has changed. It used to be over my dead body, and so I think we are in a place that things have changed pretty drastically. Interest rates, the discount rate, not to mention the way that CalPERS has been passing along costs to agencies, and to see the incredible increase over the last few years has helped to inform my change in position as well.
I'm looking at some of these charts about the the further years out, but are we talking about dollars, in current value? We can expect and have seen our revenues go up too. And so does that factor in at all as to what our risk is in doing this, that our revenues should be going up as well? So we would be better able to handle those higher payments. And both the CalPERS model shows the payments going down in future years, like kind of peaking. I don't know. I had a whole bunch of questions, but I think to cut to what's really important here is that I agree that we should start the process of doing the POB analysis. That's a low cost item. And as you explained, and we have the funding, we could go ahead and do that now. And then let's see. And when we get the results of that, what does that tell us? What will that tell us, that analysis?
So
guide us?
I want to split a hair here for a moment. So when we're talking about the analysis, we've done some of the analysis, and that's what we're seeing here today. We can continue to do that work. Essentially, it'll be some stress testing. Mike and Craig can probably speak to that a little bit more. Some stress testing, looking at volatility in the market, those types of things. What we were discussing, and this is the hair that I want to split, was going and going through the court process to essentially have the court say, this is a legal obligation that you can borrow against, that you can finance. And that's essentially what we would be doing if we were to move forward. Obviously, the analysis will continue up until the time where we make the decision, are we going to issue these, yes or no? And, if it's a no, then we'll continue with the analysis until the next time we have the discussion and consider issuing these bonds. If it's a yes, again, we'll continue with the analysis and be bringing, there will be multiple steps between here today and when we actually issue bonds, multiple touches for counsel, outside of simply the legal process, but bringing it to you with some, as close to hard numbers as we possibly can, saying these are the interest rates that we're looking at, these are the payments that we're looking at, and give a more concrete answers to some of these questions, and be able to say, here's our last chance. Do we want to yes or no? That is 6 months down the line at the soonest, the quickest that we could do this. And so it's going to be multiple conversations, multiple, opportunities for us to sort of get to a place where we go, I'm not comfortable anymore, those sorts of things. So I want to be clear there in that we're not, we're not going to proceed unless the committee and council are comfortable. Two, there are so many times that we can say, you know what, this doesn't make any sense anymore. Let's stop. Let's push pause. We can wait till, we can wait for the market to change. We can wait till, something changes in the city, all of those things. So I just want to be clear. There is, sort of continuing this path. It's a long path. And so we have multiple places that we can make different decisions.
Okay, and then we're going to see when you come out with a budget, I assume the current figures on unfunded liability. That percentage has been going up or going down. The unfunded has been going down. Do you have a ballpark on what it is right now?
I don't. I think Mike had something in the report. You're speaking just to CalPERS? Yeah,
he did. But yeah.
I don't recall off the top of my head. I can dig in the report here. I've got it here.
Well, if it's 414 million right now, and that's gone down, I would think our funded percentage has gone up.
The current funding ratios are in the low 60 percentile, but that's based on the $490 million unfunded liability. We're projecting that this summer, when the new reports come out, those will reflect the good year that CalPERS had in 21. We think the new UAL will be 414 million, and the funding ratio will be around 70%. Of course, they're having a down year this year. That's why we want to caution not to, it could be right back up again. So we'll see how they end this June.
Okay, thank you. So I think that we all agree, all three of us agree with the first the recommendation to just go forward with that analysis and continue to examine this. And then I suppose it will come back to the budget committee and then to council for a final decision on what to do. And I think, of course, we all are going to be continuing to look at the information that comes forward. My general attitude toward decisions like this, but personal and for the city, is that you hedge your bets a little bit, and that maybe a blended, a combination of strategies, which is suggested in part here, that we fund some of it this way, maybe, but not all of it. And I still, the idea of a 115 trust, have we actually set that up yet? Is that one of the things that you said we had done? I know we had talked about it a lot, but have we done that, and do we have money in it?
Well, so those are two different questions. We have set one up. We don't have much in the way of funding in there. So I'll take that back. We have a 115 trust for OPEB. We have a lot of funds in that. We also have a 115 trust for CalPERS. We have $1 in that. I take that back. It's probably got some earnings. So the dollar contribution that we made when we opened the account is probably something in the range of $1.50 by now. But it is in very insignificant amount.
Okay, so that would, yeah. Well, I like the idea of having money there to cushion in case of some kind of catastrophic change. I like the idea of having different, having some protection against the risk of, the worst outcomes. So that's what I would be looking at, I think, when we get to the final decision. Do we have kind of a combination of strategies here? But and the 115 trust, that's, in a sense, we're gambling that will earn also, or earn. I don't know, what would we expect from that to make it worthwhile, that it would earn as much or more than Cal, and is it likely to earn more than the CalPERS return?
I don't know that it's likely to earn much more than the CalPERS return. The hope is, yes, that it would, but certainly, it's going to manage in a very similar way to the portfolio that CalPERS is managing.
All right, so I think you do have what you need right now on this, is to go ahead with the analysis and, and come back and keep on, evaluating this.
Great.
All right. Thank you. Okay. And thank you, Mr. Meyer, too, for your work on this. And I suppose we'll see you again sometime as we move on with this. Thank you for making it as clear, making it really amazingly clear, I thought, considering, how I felt about this subject in the past, but I'm learning a lot as we go on. So thank you for the information. So we're going to move on to item number 3 now, which is a discussion of the fiscal year 2023 Mayor and City Council departmental budget. And I want to thank staff for their excellent putting together of the suggested. It's really improved a lot in the last couple of years. So thank you for giving us more credit than we used to get for what we do.
I will take 0 credit for that. That was all good work by Mary Thomas.
Yes, I see her here.
Mary's going to be here to present for us. I just wanted to, we have a hard stop at 6:25 this evening because we've got another meeting that begins at 6:30 that they have to switch over to be able to broadcast. So just wanted us all to kind of be cognizant of that. I don't think we'll butt up against it, but wanted to make sure that we were all aware of it. So without further ado, it's the school board meeting. Sorry. So go ahead and take it away, Mary.
Great. Thanks. So I will, 1 second, I will share my screen. Share. Can you all see that?
Yes. Oh, I can. Yes.
If I show that, are you seeing my full screen or are you just seeing the partial?
Partial.
We're seeing your notes section too.
Yeah.
Shoot, this happened to me last time. Okay, can someone else actually, Justin, do you mind sharing? Are you able to?
Let me
I'm
find
not
it.
sure how
If
to.
you want to send it, just email it over to me real quick, and then
Cool.
I can pull it
I'm
up.
sharing it with you right now, Kelly. I apologize. I just remembered, usually I share from home, and I just remembered that last time I shared from work, this also happened, and I couldn't figure out how to fix it. Okay, I just sent it to you, and I'm stop sharing. Did that come through?
I'm waiting for my mailbox to refresh.
Okay. Well,
Okay.
in short, I'll summarize the first slide, which is to say that there's no significant changes to your budget. It's just some small changes to account for some just the internal services and different things that get tweaked every year for every department. Not seeing.
Yeah,
Kelly,
it has frozen. Okay, hold on. Let me try something. Now, oh, I've lost. Okay.
Mayor jinxed it with all the
I
compliments.
jinxed it. I jinxed it by having two dual screens.
Like this should not be. Let me download it out of SharePoint.
Okay, while you're doing that, actually, what I can just do is share it, and you can just see it in my you can see it in the note format.
Yeah, that wasn't too bad.
Okay, does that work?
I've got it now, Mary. I can go ahead.
Oh, okay.
Yeah.
Thanks. 1 second.
Yeah.
I will stop sharing. There you go. Okay, great.
There. You're seeing just one screen?
Yes.
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 Yes. So it sounds like Mary, you saw, and hopefully you guys were able to review the list in the staff report. Oh, this is just showing the budget. So yeah, it's a slight increase, but that's just due to normal annual budget increases from staffing and different things. So Kelly, you can go to the next slide. So for the there's actually 4 slides of these, so it's a lot to look through, but I tried to highlight some key terms. So maybe we'll just go through these and we can go back if you have questions about any specific ones. So these first 4, the first one focuses on kind of the COVID-19 pandemic emergency and reopening of city facilities in the downtown, as well as the second one focuses on community services related to COVID-19, like the vaccination site, as well as you guys adopted a plan for the ARPA funds and adopted MOUs with Local 21, HAME, and SEIU. Next slide, Kelly. Also worked on the strategic roadmap projects and provided direction. Number 6 here is the different public safety initiatives like the HART program and the dispatch center evaluation. You also adopted this year the Let's House Hayward plan. The groundbreaking happened for the Depot Community Apartments, and the apology resolution was adopted in October. Next slide. There's also a resolution welcoming and calling for support for Afghan refugees and the launching of that resource center at MJCC. There was a resolution to raise the Pan-African flag. And then I lumped some of the sustainability efforts here in a row. So adopted the Renewable 100 as the default electricity project, approved an urban water management plan, adopted resolution to have a goal towards zero emission vehicles, joined All In Eats, and provided direction on negotiations with waste management. Next slide, Kelly. We received the biannual resident satisfaction survey, reviewed and provide direction on fireworks mitigation, and there's more coming next Tuesday on that item. The Heritage Plaza had its grand opening, and the Kirby the Bookmobile launched. We had the City Hall DU in the fall, and we're working on the people's budget. We've launched, you've approved the plans to launch the community engagement for all the general plan amendments, adopted amendments to commercial cannabis, and approved we listed a few of the development projects you've seen, like Berkeley Farms and the Burlington Coat Factory. Next one, Kelly. This is the last slide. Also provided direction on the SkyWest property, continued to oversee Route 238, including approval of 250 new housing units, accepted grant funding and approved plans for some transportation improvements, held a joint work session with HUSD, completed the annual performance evaluations, and then we will put in the proclamations and accommodations. We're finalizing the list for this spring, so by the time the budget is adopted, you will have the final number and the modifications and edits to the council handbook. So it's been a busy year. So I'm prepared to take any notes on additional things you wanted to add or amend.
Okay. Anyone have anything? Councilmember Wahab.
Definitely. Well, one, I just want to appreciate it because when it's listed out like that, it really shows you what you've actually been doing, right? Versus, and there's a lot of like, okay, noise. Okay. So I think one, I think that the efforts from every single staff member that has worked on kind of the Afghan refugee crisis, you know, I would like to acknowledge, just because a lot of them were spending a lot of their volunteer time, you know, from Daniel to Zach to, you know, Laurel and Kelly and basically everybody, right? So I definitely want to highlight that. I also want to highlight, there's a couple of other things that, can you go back to your slides? And I apologize.
Kelly's.
Oh, sorry.
That's why I see you're working on it. If it's frozen, Kelly, I can pull up mine and that.
I made the mistake of closing it out, which was silly. Give me 2 seconds. It's pulling up now. There we go. Okay. Which slide would you like to go back to?
Let's start from 3, and I think that's where all the words started. Let's see.
Yeah.
I know the increase in expenditures. I know Kelly usually writes something about that, so I'm not too concerned about that. And once we review that, you know, we're happy to talk about it. You know, I think one of the other things that needs to be highlighted is the fact that we did approve a Sprouts and a, you know, from the Economic Development Committee. I know it hasn't been like groundbreaking yet, but I think a lot of residents were very happy about that. And that was a, you know, final decision, if you will.
Yeah,
and
we
then
can pull that one out. Yeah.
And then I think that also highlighting the fact that we did 100% affordable housing. That's a big piece of it too, because we do try to talk about affordable housing as much as possible.
What do you mean? What do you mean we did 100% affordable housing?
Parcel Group 5, that plan was approved 100% affordable.
Well, but that's one. I mean, that's one project. You don't want to call out every project.
I don't, but 100% affordable housing is not, as, you know, it doesn't happen every year and it doesn't happen in every city.
We can we can highlight that project.
Okay. And then if we can go to the next slide. Yeah, I just wanted to give kudos to the Heart team, like everybody who's worked on that. I think that in this line of line 6, potentially even highlighting and referencing even the GARE team, because they've been very much a part of the larger effort, if you will. I know it's more words, but you know, like I said, they put a lot of effort into that. And then next slide, if you don't mind. And then one more, I think, right?
Yeah, there's one more slide. Actually, there's two more slides. There's one more after this too.
Yeah, and I think Kirby is, our library efforts, are genuinely pretty impressive, and just everything we've done around that. And then if we can go to the next slide. Okay, and I always have to remember how we do this when we go backwards. Are we going to highlight that we also, maybe that's for this year, but how we did a joint planning commission meeting as well?
We can do that. Yeah, so this covers July through June. So we're missing, we're kind of, if there's anything that's going to happen in the next few months, like let's put that in so we can do a joint.
I think you
joint
could
planning.
probably include it like with number 21.
Yeah, say a joint.
Having
21 or even the next slide had I don't know what number it is.
With HUSD. Yeah,
HUSD and, well, I don't know if we want to put but, semicolon and planning commission, right? Because we are trying to.
It probably would go better with the one on the slide before, because that's what we're going to be talking about.
Yeah, potentially, right? So just as long as we include that we also spoke to the planning commission, and we're trying to get a little bit more of a unison approach. I think that's a plus. And hopefully next year we can talk about how we partnered with Cal State East Bay on the incubator setup, but that's a future item. But no, I really do appreciate this. I think high level, these were all the things that we wanted to highlight. So
okay.
Thank you.
Great.
Thank you. And Councilmember Lamnon.
Thank you. Let's see. So actually I did have a question about the finances. Thank you for the work on this. And it is an exciting list.
Kelly, can you go back to slide 2?
I'm working on it.
Okay.
Thank you. They're fading. It's okay.
Taking a long time to fade.
There we go. Thank you. So I noticed that the regular salary is higher. I know it's not a lot higher, but I was curious why that was.
I will have to defer to someone in finance for that.
So this should only include the council salaries.
Correct.
But
Yeah.
I think it includes a portion of Chris's salary as well.
So we had pulled that out.
We had
ago just because it got
Confusing.
confusing.
Yeah,
Yeah,
let's double check.
However,
But
I
we would
truly
have-
think that including a part of Chris's salary is appropriate myself, but but it is a good question as to explain why it's going up when our salaries, unless you're including what I was going to suggest, that we actually consider the COLA increase that was built into, or at least a partial that was built into the original authorization for the salary increase when it was done in 2001, and which we have taken once and then rescinded. So we're back to those base salaries, basically, of, that were reset in 2001. That's been 21 years. And,
Wow.
I don't even know what the salary, and I'm not saying that I think, we should have taken those COLAs every year. However, we've never taken them. Or it's basically, a wash. We took it once and we took it back. And so, that was I think that was during the recession. But, they really never, they've really not been raised at all. And I think it might be something, and I know, council is always, rightly so, concerned about, how people will react to us raising our salaries, but that was built into the plan. It wouldn't be like we would be changing our salary structure. We would just be taking the, and I'm not even sure how that was structured, but it was a COLA, an annual COLA. I don't know. That would be something that I know that I've heard from some other council members, that it starts to be really difficult to do this job. and, have to work full time as well, because and not that adding a COLA in, but it might really be time at 21 years to actually take a COLA. And, that's something that would be decided on an annual basis, depending on the city's salaries. I'm not necessarily recommending it or even advocating, although I think it would be a good thing to consider at this point. And I wondered if I'm sure that wasn't what caused that little bump up in the amount there, but
I'll look into the difference for you, Councilmember Lamnin.
Thank you. I appreciate it. I know part of it was us being restored from our give back, but
Correct.
just, yeah, I appreciate the look into. And I don't disagree with you, Kelly, that Chris's salary should at least in part be assigned to our department. I would just ask that if it is put back into this budget, that it be broken out as mayor and council salary and admin or secretary.
Yeah, and so it's
so there's
that would be,
'cause
that's challenging because we don't do it at that level of detail in the budget document. So I think probably I get why we pulled it out, and it probably makes sense to leave it pulled out.
okay.
Okay. I am not, I am open to a conversation. I think there was something about if you do a salary increase for council, it actually only takes effect once the current council's term has ended or something. But I'm open to I'm open to the conversation.
Although I don't think that necessarily would apply to taking the COLA that was built into the original, the original action that was taken in 2001 to raise the salaries. That's something to look at. But I mean, if we were to redo that whole action and raise the base salaries up, but that action in 2001 included the possibility of an annual cost of living. And I'm not suggesting that we raise it to what it would be if we take it every year or anything like that. And that would be, yeah. But I don't know, maybe staff can look at that because I would suspect that putting the COLA in would not come under that rule about, waiting until, the term ends.
We will do some research, and we can, if the committee, I mean, if the majority of the committee is open to the conversation, we can include a discussion of that when this comes back to council for consideration. And probably on the Saturday budget work session, we can probably raise it at that point.
Okay, so I'll ask for comments on that. But the only other thing that occurred to me was,
Mayor?
Yes. Oh, Sarah.
Could I finish, or do you want to come back to me?
Oh, I was just going to finish my comments on the overall thing, not on that part of it. The only other thing I thought about potentially adding in was the representation on, well, first of all, committees like this, but also our representation on outside agencies. We have several outside agencies that we have a council representative on. So that might be something to add to our very comprehensive list here. But
definitely add that in.
Okay, so now we'll go back to Councilmember Lamnin.
Thank you. Appreciate it. It's a good idea. And I'm open to having the conversation about council salaries. Then in terms of the list, you can take down the slides. Or actually it may be easier if I say, never mind, leave it. Leave it, sorry. In item 5, there's actually I probably should have kept it up because
we all should have it in our packet. We have this.
Yeah, no, we do. I just didn't have it in front of me. Anyway, there's in item 5, there's a comment of the that we were with the city. Thank you. Sorry. Policy direction for the city manager, and I was just thinking that probably is city leadership, because while a lot of it sits under CMO, it's not only.
Well, or city staff.
Well, we give policy direction to the city leadership, right? And then
we're the city leadership.
Okay, so city staff. Okay, yeah, that's fair, for sure. And then in number 8, I was wordsmithing around people who are homeless. So I'll I'll write it rather than say it. Or I was thinking households who are formerly homeless and or low income. As opposed to
Households who are formerly homeless or low income.
households who are formerly homeless or have low income. It puts the person first.
Okay, I got that.
Okay, awesome. Thank you. And then number 9, I'm wondering if we wanted to include per recommendation from CSC.
Got it.
And then the last one, item 10. Thank you, Kelly. For support of Afghan refugees and coordinated with staff and community partners to help launch a resource center. This is great. Thank you.
Okay.
Thank you, Mayor.
Okay, and I'm sorry, I realized I did kind of cut into the middle when we started talking about the salary. So I just thought I'd finish off mine because all I had was those committees and outside agency thing. Councilmember Wahab, what are your thoughts about bringing into the discussion that we have a council of enacting the built-in COLA this year?
You know, I think that for working people, especially if elected office has been designed right now mostly for retired folks or people who have an affluence of time, as I always often mention. I think it's fair to, especially if we want more people involved and people that have competing priorities, that it's fair to increase their pay just as we do for all workers. I think that's fair. I think Councilmember Lemon is correct that when it's enacted, it's after, I think 1 year after, and maybe not even a full term, but I think 1 year after. So that needs to be reviewed. But I know Hayward is paid better than some cities and less than other cities. Some cities only get a stipend as well. So, but there are growing members of the community that would like to run, but cannot run because it's not fiscally responsible for their families.
Yes, and that I'm hearing that. We even had a bunch of, they were students come in a few years ago and tell us that we should do that because it's, they were shocked at how little, but it's a hard thing. I mean, we do a lot of work though, and I think this list shows it. And that's why I wanted to add in also the representation that we do on our committees and our outside agencies. That will have to be researched. But I mean, if we were to actually do an increase in the base, if we were to change that 2001 legislation, but that 2001 legislation did include that annual cost of living adjustment, which I don't think would be subject to that limitation of waiting until the end of, a term before it could be applied. So that's some staff.
We'll research that, and then we can, it sounds like all three of you are supportive of that. So we'll bring back that as part of the discussion on the Saturday budget work session and have a full analysis of what the process is and what what was adopted actually says.
Possibly if we can also tie it into where if we are taking from the reserves, we don't get the COLA increase. I think that there needs to be language for responsible.
Well, I don't think there is in there, but that's an idea too, to put some language around when we would or wouldn't take that increase.
Yeah, because I think as city leaders, we always have to give up. We should be the first to give up. And I think that, we did that obviously in this last COVID situation, but it's important regardless of, how small or large the amount of funds are.
I mean, COLAs aren't guaranteed for any employee group even. I mean, we always look at our budget every year, but 21 years now of not, it'd
be interesting to see what that percentage would be. But also in 2008, obviously the economy tanked too. So it's just interesting to see the numbers in 20 years, what it always looks like, cost of homes and salaries and so forth. So.
Right. All right. So we're just close to the when we have to end. We have another item, and that is the fiscal year 2023 budget process. Does anybody have any, and also the agenda planning calendar. So let's try to do that. Well, my laptop here only says it's 5:26, but that's not true, is it? Okay. Who's going to take those two last items then?
I'm happy with the schedule. I just want to highlight the public bank. Have we had conversations as to, are they ready or are they not ready?
So I received an update from them this morning, and I responded and asked that they let us know as soon as they are ready to come back and present to the committee.
Okay.
And so once they've given me a timeline, my guess would be at the upcoming either April or May meeting. Could be June. I'll let you all know as soon as I do, and we'll get it on an agenda as soon as we can.
Okay. And then this may not even apply to this committee, but the conversation about reparations, which committee are we doing the bulk of the work, if you will?
So I think there's a couple different pieces, and now actually Regina can chime in on the Russell City. There is a work plan item for the Housing and Homelessness Task Force that is related to a first-time homebuyers program that includes that, but I'll let Regina talk about where we are with the Russell City work and kind of where that might come into play.
So where we are right now is in a planning phase and research phase. We've been speaking with individuals from across the country who have done reparations work in municipalities, and they've asked us to use the language of reparative justice because of Russell City being a multicultural community, and generally reparations and the language of reparations is reserved for individuals of African descent or descendants of slaves in particular. And so we have met internally to develop a communication strategy. We'll be getting back together in a couple of weeks, but we intend to first and foremost do a media push so that we make sure that we have all of the voices at the table. Right now, there are probably 3 different independent groups meeting about Russell City. And we want to make sure that we bring all of those voices together, and then having the city not necessarily own the process, but provide facilitation, a means for facilitating the conversations. Once we have everybody at the table, we're going to begin our listening and work with the group that's at the table and possibly circle up to develop a decision-making structure and framework, because once we really get down to brass tacks and talking about solutions, we need some ability for individuals to kind of serve as representatives of various parts of the Russell City community to put together recommendations that will ultimately be brought back to this body.
Okay.
Or to the council as a whole.
And I just want to always highlight the conversation that, not everybody's going to be happy with the outcome, and that, people need to understand that this is, we're doing our best and well-intentions are ahead of us and so forth. So I always like to preface these types of conversations with that. But other than that, I think I'm fine. I also don't want to limit the down payment assistance program. And the first time I've said this publicly many times. So I just want to highlight that.
Okay. And then you were fine with the budget process schedule.
Yeah.
Thank you for doing this too, your comments on the 2 items, and go ahead, Councilmember Lamnan, do the same.
Yeah, I didn't have any comments on either. Thanks.
Okay. All right. I had, I'm fine with the budget process update. Thank you. That looks like a good schedule. I would like to highlight the need for us to again address the community foundation, which is still on the unscheduled items list. And when we do discuss the parcel tax, I'd like that to include a list of all the current Hayward taxes that we have enacted and their sunset dates, so we can really look at what we've done over time. And okay, but that's all the comments I have. So with that, unless anyone else has anything else to say for the good of the order, and I'm not seeing any hands up from committee members, we have we're a minute over maybe, or just at our hard stop. So is that okay, Dustin? All right. So with that, this meeting is adjourned. Thank you, everybody.
Good night, everybody. Thank you.